Michael Burry, the legendary investor who predicted the 2008 crash, just made his biggest bearish bet ever. A staggering $1.6 billion against the U.S. stock market. He's not just talking about a crash anymore. He's putting his money where his mouth is. Even more shocking, he's completely exited his U.S. positions and is betting big on China. Let me show you exactly what Burry sees coming and, more importantly, what you need to do right now to protect your wealth. Before we dive into Burry's warning, let's understand why Wall Street listens when this man speaks. Michael Burry isn't your typical Wall Street analyst. He's the genius who saw the 2008 housing crash coming when everyone else was blind to the risks. While banks were claiming the housing market was rock solid, Burry was poring over thousands of mortgage documents, spotting the cracks that would soon bring the entire financial system to its knees. His billion-dollar bet against the housing market wasn't just lucky. It was the result of obsessive data analysis and the courage to stand against the entire financial establishment. This story was so incredible that it became the subject of the movie The Big Short, where Christian Bale portrayed Burry's intense dedication to uncovering the truth behind market facades. What sets Burry apart isn't just his past success, it's his approach. While most investors chase trends and headlines, Burry digs deep into data, looking for disconnects between market perception and reality. He's known for his contrarian views, but here's the key. When he takes a position this big, it's not for shock value. It's because he sees something in the numbers that others are missing. Now let's talk about what's grabbing headlines right now. Burry's massive bet against the U.S. stock market. According to recent SEC filings, his fund, Scion Asset Management, has placed a $1.6 billion bet against the S&P 500 and NASDAQ 100. This isn't just another hedge. It represents over 90% of his portfolio. Let that sink in. One of the most successful predictors of market crashes is betting almost everything he has on a market downturn. But here's what makes this move even more dramatic. Burry isn't just betting against U.S. stocks. He's completely restructured his portfolio. He's sold off his positions in major U.S. companies and regional banks, and in a move that's raising eyebrows across Wall Street, he's shifting his focus to Chinese markets. Burry's dramatic shift towards Chinese investments isn't just a minor portfolio adjustment. It's a seismic strategic shift that's sending shockwaves through the investment community. In his latest moves, Burry has taken substantial positions in companies like Alibaba and JD.com, seeing value where others see risk. The timing is particularly striking. While most investors are fleeing Chinese markets due to regulatory concerns and economic uncertainties, Burry is diving in head first. The logic behind this move becomes clearer when you look at the valuations. Chinese tech giants are trading at price-to-earnings ratios that are a fraction of their U.S. counterparts. For instance, while Amazon trades at P/E ratio of 49.5, Alibaba sits at just 17.68. In Burry's view, this massive valuation gap represents an opportunity that outweighs the geopolitical risks. But this isn't just about finding bargains, it's about seeing the bigger picture. China is rolling out a massive $1.8 trillion stimulus package focused on infrastructure and technology, a move that Burry believes could reignite growth in the world's second-largest economy. This combination of undervalued assets and government support creates what Burry sees as an asymmetric betting opportunity, a limited downside with significant upside potential. But Burry's bet against U.S. markets isn't just about finding better opportunities elsewhere. It's about the dangerous cocktail of risks he sees brewing in the American financial system. Let's break down the three major red flags that have Burry so concerned. First, there's the Buffett indicator, which has reached levels that should terrify any serious investor, currently sitting at an astronomical 208%. This measure of total market capitalization to GDP is screaming overvaluation. To put this into perspective, during the dot-com bubble, arguably the greatest speculative mania in modern history, this indicator only reached 140%. Even at the peak before the 2008 financial crisis, it was just 110%. Today's reading isn't just high, it's in uncharted territory. Second, we're facing an unprecedented debt crisis. The U.S. national debt has surged beyond $35 trillion, creating what Burry calls a debt spiral. With interest rates at their highest levels in decades, the cost of servicing this debt is becoming increasingly burdensome. Every time the government needs to refinance its debt, it does so at higher rates, creating a snowball effect that could eventually become unmanageable. The interest rate situation particularly concerns Burry, and here's why. For over a decade, both the government and corporations have grown accustomed to dirt-cheap money. They've built their entire financial strategies around the assumption that they could always refinance at lower rates. Now, with rates at multi-decade highs, that assumption is being shattered. Consider this. A significant portion of corporate debt needs to be refinanced in the next few years. Companies that borrowed at 2 to 3% will now need to refinance at rates that could be 3 or 4 times higher. For many companies, especially those with weak cash flows, this could be the difference between survival and bankruptcy. This leads us to what Burry sees as the Fed's impossible position. On the one hand, they need to keep rates high to fight inflation, which remains stubbornly above their 2% target. On the other side, these high rates are putting enormous pressure on both government finances and corporate balance sheets. The Fed is trying to thread an increasingly narrow needle, fight inflation without triggering a debt crisis. What makes this situation particularly dangerous is what Burry calls the everything bubble. Unlike previous market bubbles that were concentrated in specific sectors like tech stocks in 2000 or housing in 2008, today's bubble is more pervasive. It spans across multiple asset classes, from stocks to real estate to corporate bonds. This widespread overvaluation is precisely what makes the current situation so precarious. Looking at the stock market, the signs of excess are everywhere. The S&P 500 and NASDAQ have reached new highs despite growing economic uncertainties. Companies are trading at valuations that assume perfect execution and endless growth. What concerns Burry isn't just the high prices. It's the disconnect between these valuations and the underlying economic reality. Take Tesla, for instance. Despite facing increasing competition and margin pressures, it still trades at a P/E ratio of 12.74%. Suggesting market expectations that may be difficult to meet in an increasingly competitive environment. This is just one example of what Burry sees as widespread market complacency. But the stock market isn't Burry's only concern. He's also warning about growing risks in the real estate sector, particularly commercial real estate. With remote work becoming permanent for many companies, office buildings in major cities are sitting partially empty. Yet these properties still carry massive debt loads that need to be serviced. As these loans come due for refinancing at higher rates, we could see a wave of defaults that ripples through the entire financial system. Perhaps most alarming is Burry's warning about inflation. While many believe inflation has been tamed, Burry sees current relief as temporary. His analysis suggests we're in for a second wave of inflation, potentially more severe than the first. The reasoning is straightforward. Massive government spending, combined with ongoing supply chain issues and geopolitical tensions, creates perfect conditions for renewed inflationary pressures. Just as he predicted in January 2023, inflation is showing signs of re-acceleration. March 2024 saw inflation tick up to 3.5%, above the previous month's readings of 3.2% and 3.1%. This isn't just a statistical blip, it's exactly the pattern Burry warned about, where temporary relief would be followed by a more persistent inflationary surge. What makes this situation particularly complex is the global interconnectedness of markets. China's property sector struggles, Europe's energy challenges, and various geopolitical tensions create a web of risks that could trigger a crisis from unexpected directions. Burry's move into Chinese assets isn't just about finding value, it's about positioning for a potential shift in global economic power. So, what can investors do to protect themselves? Burry's own moves offer some clues. First, he advocates for careful consideration of international diversification. While many investors have a home country bias, Burry's pivot to China demonstrates the importance of looking globally for opportunities. Second, he emphasizes the importance of value over growth in this environment. Companies with strong cash flows, solid balance sheets, and reasonable valuations are likely to weather the storm better than highly speculative growth stocks. This explains his recent investments in sectors like healthcare and travel, where he sees tangible value rather than speculative growth. While Burry's massive market bet might be beyond the reach of ordinary investors, his warning signs offer valuable insights for protecting your portfolio. Let's break down practical steps you can take based on his analysis. First, consider your cash position. Both Burry and other legendary investors like Warren Buffett are maintaining significant cash reserves. Cash isn't just about safety, it's about optionality. When markets decline, cash gives you the ability to acquire assets at discount prices. Think of it as dry powder for future opportunities. In an environment where Burry sees significant downside risks, having a larger cash position than usual might be prudent. Second, look at your diversification strategy. Burry's move into Chinese markets highlights the importance of geographic diversification, but it's crucial to understand that following his exact moves might not be suitable for everyone. Instead, broader international exposure through established markets and carefully selected emerging market opportunities should be considered. The key is to avoid having all your eggs in the U.S. market basket. One of Burry's consistent themes has been the importance of hard assets in an inflationary environment. Physical assets like real estate, commodities, and precious metals often serve as inflation hedges. While Burry has been cautious about commercial real estate, he sees value in residential real estate and agricultural land, assets that maintain intrinsic value regardless of market conditions. Gold and silver, traditional safe haven assets, also fit into this strategy. As Burry points out, precious metals have historically maintained their value during periods of currency devaluation and market stress. While he doesn't advocate for moving entirely into these assets, he suggests considering them as part of a diversified portfolio. The most pressing concern in Burry's analysis is the impact of rising interest rates on debt-laden companies and individuals. His advice here is straightforward: reduce debt exposure. Companies with high debt loads are particularly vulnerable in a rising rate environment, especially if they need to refinance in the next few years. This applies to personal finances as well. With credit card rates at historic highs and mortgage rates elevated, Burry advocates for debt reduction as a key defensive strategy. The logic is simple. In a potentially challenging economic environment, lower debt levels provides more flexibility and resilience. Despite his overall bearish outlook, Burry isn't suggesting investors should completely exit markets. Instead, he highlights the importance of selective positioning. His recent investments in healthcare companies like CVS and Cigna, as well as travel-related stocks like Expedia and MGM Resorts, show he still sees opportunities in sectors with strong fundamentals and reasonable valuations. The key is to focus on companies with pricing power, strong balance sheets, and essential products or services. These businesses are better positioned to weather economic storms and potentially emerge stronger on the other side. What do you think about Burry's massive bet against the market? Are you seeing similar warning signs in your own analysis? Let me know in the comments below. And don't forget to subscribe for more market insights and analysis.